Well, I do want to talk about my generation, the millennials. We were really coming of age during the crisis. So how would you advise us to prepare, and I guess, what would you tell our generation? We feel scarred from the crisis.
Yeah. First of all, I think one of the problems is that the experience that you had as the last experience is the one that's going to stick in your mind and probably will not be the one that's going to get you. So that the next experience will be very, very different. I know my parents went through the Great Depression, and then they missed out on the boom because they were always thinking about that. And so I think that what they need to do is see all of those crises. That's why you can see inflationary ones and see all of those, and once you get that perspective, I would say three things to your generation, okay? Three recommendations. The first recommendation is to think about your savings and how much money do you have for savings. And the best way to think about that is to think, how much money do I spend each month and how much money do I have saved so that I can, how many months am I going to be okay without that? And to value savings, right? And calculate it, because savings in that is freedom and security, and think about what that is. So that's the first. How much do I have for that? The second thing is, how do I save well? What should I put my saving in? And when thinking about what you should put your saving in, realize that the least risk investment that you think from volatility is the least risk investment, which is cash, is the worst investment over a period of time. And you could judge that by judging the rate of inflation in relationship to the after-tax income you're going to earn. So if you have an inflation rate that's 2 or 3%, and you're earning 1%, and you have to pay taxes on that 1% or the 1 or 2% that you're going to get, you're going to get taxed essentially at 2% a year, and that's going to be a problem. So you have to move into assets that are other assets that are going to do better over a period of time. And when you do that, the most important thing I can convey to you is to diversify well, because I can guarantee you that one of those assets, and you won't be able to pick the right one, will be disastrous in your lifetime, that you will lose half of that savings if you're in the wrong one, and you won't know what the right one is. And so pick different countries, pick different asset classes, and I could probably take too long explaining how you might do that. But so that would be the second thing to learn. First thing is think about how to save. Be cautious about debt. When you're thinking about debt, think about, is that debt going to help my savings, or is it going to produce an income? Sometimes debt, like buying a house or buying an apartment or buying an asset, it produces forced savings. Forced savings is a good thing. Or if you're taking on debt and you're thinking, am I going to have that debt in an asset? That asset better produce more income than the cost of your debt. If you're using debt for consumption, that's not a good thing to do. Okay, you're giving up that safety. So number one is think about how much you save and think about whether that should be how you borrow. Number two, make sure that you think about the diversification of that, not in cash. And number three, do the opposite of what your instincts are. If you're going to play the game, it has to be the opposite of what your instincts and the crowd says, because the market reflects the crowd. So you want to buy when no one wants to buy, and you want to sell when no one wants to sell, right?
Right.
So, and that's emotionally difficult, and probably you're not going to play that game well, because it takes a lot of resources to play the game. We spend hundreds of millions of dollars each year to try to play that game well, and it's a tough game to play well. So I would caution you about the market timing game, but I would say that if you're going to do it in the ways that are uncomfortable, because they're opposite your instincts.
That's really good advice, Ray. One more thing that really resonated with me in the book was, if in the next downturn, some of the implications could be the impact on pension obligations, health care. Is my generation going to be on the hook for that?
Yeah. So we pay a lot of attention to debt, and we should, but pension obligations and health care obligations are just like debt. There are obligations that require cash to fund those things. And when you think about that, we don't have enough money to fund those things. And so there'll be a squeeze. And I think that's also part of this political conflict, because when you say to somebody that you're not going to be able to fully fund their pension, or how are you going to fund it, what are you going to take it away from in order to fund it? Or if you think about the healthcare issues and so on with the demographics, and those require taking things away from people that have been promised to people, and or do you print the money? These are issues that will be important for your generation.
And not only are you an incredible money manager, but you're also a really big philanthropist. And when you're talking about the next downturn, you're also bringing up some big social issues, the wealth gap. How do you think about that? How do we address this issue? Because it sounds like it's going to be a very big problem.
Yeah, I think capitalism has got to work for all the people, and democracy's got to work for everybody. And we're in a situation right now, because of a lot of things, that it's not working for a large portion of the bottom 60%. I separated the averages to the bottom 60% and the top 40%. I could have done it the 80% or even 95%. And it's not working for a large percentage of the population. We don't have adequate education. We don't create bottoms. In many cases, my wife works in Connecticut to try to help what are called disengaged and disconnected youth. Let's give you a picture. Connecticut, which is the richest state in the country, or equal to the richest state in the country, has 22% of its high school students are disengaged or disconnected. Disengaged means they attend high school, but they don't really study, they just sort of get through. And disconnected means they don't even know where they are. 22%. Those students, those people are going to be on the street. That's a problem. There are school districts in which they have to share books, or in some cases even have to share pencils. They literally will break a pencil in half and sharpen it from both ends, or pass it around and so on. And that issue about opportunity in terms of education or even income opportunity. There's a population that in that bottom 60% where opiate use is rising and suicides are rising. That, I think there has to be considered a national emergency in which we create metrics. What are those conditions? And that there should be a dealing with that. I think that these things can be dealt with much, much better, but it has to be treated in a way that that's dealt with. And that has, by making them productive. I don't mean by giving money or by giving welfare, but by doing certain things, probably in private-public partnerships, in which the private sector, that could be business sector, together with the government sector, can do the checks and balances to make those things productive. I see many of these cases. I fund, for example, microfinance. Grameen America is one, but a number of those. And the capacity to lend somebody $1,000 and get paid back, not 99%, 98% payback rates. And that $1,000 can create the purchase of a rug cleaning piece of equipment, and that person's in business to be able to be productive. Those kinds of things need to be thought about, because if we don't have capitalism working for the majority of people, it's going to be threatened. And the same thing is democracy. The democracy is based on the notion of compromise to be able to bring people together and so on. I think if we have too much fragmentation, I think that these are the biggest risks. I think debt crises can be managed, but when you get into bad situations, as a basic principle, if you have rich and poor living together, and they have to decide how they're going to spend a budget, how they divide a pie, and you have an economic downturn, you're probably going to have a conflict. And I think that has to be dealt with.
We're really railing against how much money we spend on old people in the United States government system, as opposed to how much we spend on young people. Mm-hmm. And in that article, the ratio was 7-to-1. How much of the budget goes to paying for things for people over 65 compared to paying for things for people under 21, I can't remember if it's 21 or 25, whatever, but young people. And if you're investing in dying people, and not investing in the future, you don't have a very bright future. And so millennials are starting to understand that the baby boomers have all the wealth, and millennials don't really, I mean, they can't afford a house, you know, they've got student loan debt.
Right.
And they're starting to believe, I think, finally, that they kind of got screwed by the system.
When you see a number like 22 trillion for the nation's debt, are we past the point of no return? What does the day of reckoning look like?
Yeah, I think we are really at that tipping point. So since we're not going to do anything about it in the next couple of years, almost certainly, I think once we get to 2020, 2021, I think you will be past the point of no return. And so you're just going to have to deal with it. And one of the problems is that we have 22 trillion in debt, and it's growing very rapidly. But we also have $123 trillion in unfunded liabilities. The state and local pension systems in the United States, on average, are 50% underfunded. So if you take a look at Illinois, there's no chance that Illinois can honor its pension obligations to its public unions. It cannot do it. So what's the solution? Well, the solution is you have to cut benefits. When you have $123 trillion of unfunded liabilities, you have to decommit. You can't fund them. To fund them, it would be amazing. I mean, we'd have to go to, if we funded $123 trillion of future liabilities, that's 6 times GDP. If we did that over a 60-year period, we would have to take 10% of our GDP every year and put them aside into funding these liabilities. So we'd go from an economy which is 6% in deficit to, we'd have to go to one that's 10% in surplus. So it would be 16% swing from where we are today. So we cannot fund these liabilities. So what has to happen is we have to raise the age of entitlement eligibility, and we're going to have to cut people out even though we told them that they were paying into the system as sort of an insurance program for Social Security. And that will happen, and it will happen remarkably easily.
Do you think the politicians will do that, though, because
Yes.
they've made all these promises? Okay.
Because the awareness of the trajectory will become too obvious.
Right.
And so people will say, you know what? I know I was supposed to get Social Security when I was 65, but you know what? I guess it's okay if I get it when I'm 72. And certainly the millennials are going to have eligibility that's probably 75. And some people like me won't get anything.
Because I actually want to talk about you and DoubleLine. This is your 10th anniversary, I believe.
Yeah,
10 years running DoubleLine.
10th year.
You've been in the business for over 35 years. You are the bond king now. You are.
You say so.
That's what people say.
I never invited that, but that became
Got
a
it.
drama that the media liked.
Well, you're a prominent bond investor.
Yes,
Most of
that I am.
DoubleLine's strategies are in fixed income, but I've noticed that you have been diversifying a lot lately. So I'm curious, where are you finding opportunities and what's exciting to you?
Well, we've been diversifying, first of all, because we could. We were approached by Barclays Bank to run a smart beta equity fund using someone they were working with, Dr. Schiller, the Nobel Prize winner, on the relative CAPE ratio. And it turned out that that strategy had tremendous success. I think it's the best performing large cap strategy in the country since we launched it. And that was good because it was successful, and it's over $10 billion. And we started a liquid real estate fund, which I think is really interesting, with Colony Capital, which we just started launching, that actually invests in all manner of REITs that are brick and mortar REITs, but also includes digital assets. It's not just malls, buildings like malls and nursing homes. That's part of it.
Right.
It's much bigger than that.
Like almost like newer economy.
Yeah, there's a lot of it's new economy, like satellite towers and stuff. And that uses a smart beta approach too. It's just got started. We'll see if it works. It launched it at a great time. I mean, it was like end of part of last year, which is a great time to launch anything because markets have exploded to the upside. But right now, in the fixed income market, the strange thing is, I think the most exciting thing is the 2-year Treasury. Not that it's great, but its yields about the same as the 10-year. It's at 2.5, which is okay. I just think that interest rates have a bias to rise on the long end, and I think it's late enough in the cycle with enough leverage in the corporate economy that if we continue to roll on with attractive gains in risk assets, I'm pretty sure it's at the end of the game. And you're going to be better off waiting and foregoing those gains because your opportunity set will be vastly better when the next recession comes. And as we said earlier, can't really see a recession in, say, by middle of this year. We can always get surprised, but our indicators don't show it. But once they roll, but they are starting to show signs of cracking. Not convincingly that you have to act today, but when the next recession comes, there's going to be an outrageous opportunity in corporate credit. And I think you want to own none right now, none. And instead, you just say, I might lose a few percent versus playing in that game. But when it goes down, well, we saw what happened from October 3rd until Christmas Eve. I mean, there was a pretty big drop. And I think that that's just kind of a taste of things to come.
Kind of reminds me when you called the housing meltdown and you were one of the first to put capital to work. Is that kind of what you're seeing when it comes to corporates? Are you?
Yeah, I called it, but I wasn't one of the first to put capital to work. I actually raised a distressed fund starting in February of 2007. And it was an interesting period because the institutions that I was suggesting this idea to, they were debating whether I was right more than anything. They were saying like, well, no one else says this. You say the housing price is going to drop 35%, which I said in Barron's in December of 2006 when they were down by 0.5% so far. It's a long story. I won't get into it for time. But I knew what was going to happen in the housing market. It took a little longer than I thought, maybe by about 6 or 8 months. But then what I became known for is I spoke at a very prominent conference in June of 2007. And I went on stage not fully sure what I was going to say. I didn't have any notes or anything. I had some slides. And all of a sudden, seemed like it was the right moment. And I made the declaration, I'm going to get to the credit markets later on in this talk, but I'll just give you a hint. Subprime is a total unmitigated disaster, and it's going to get worse. That phrase was captured in the media on 5 continents. And at that time, the subprime sector, the AAAs, the AAs, they were still trading at 100 cents on the dollar. They hadn't dropped at all, 0. And they really started dropping in earnest in the first part of 2008, later part of 2007. I didn't really start putting money to work until March of 2008 after the Bear Stearns collapse. Right. Because by then the prices were low enough where you were pretty sure to get more than your money, what you invested, your cost, you're likely to get that back. But I knew it was going to go lower. I actually did I announced to my investors in March, at that moment, March of 2008, I said, I just want you to know I value transparency. I'm going to start buying credit. I warned this was going to happen. I said the prices were going to collapse. I think they're low enough that I'm going to start buying them. But I want to buy so much of this stuff that it's probably going to take us like a year to get, and we didn't really get fully invested until March of 2009, which, as good luck would have it, turned out to be the bottom. So, yeah, I think something along those lines is going to happen, but it's not going to be in the securitized markets. It's going to be in the market that's misrated today. When you're looking for distressed opportunities in fixed income, the best ones come from things that are misrated going into the problem. Because the people that buy investment-grade corporate bonds are looking for safety. Right. They think they have safety. When you buy a AAA-rated subprime floater, you're a AAA person. You didn't sign up for a lot of risk. You signed up for a little bit of reward, hoping that the risk was de minimis. But then it ends up being a big risk. And so it's not surprising that the people that sign up for safety sell when the market goes down, because their eyes have been opened and they now realize that they were fooled. They thought it was safe, but they were wrong, or so they were lied to. And so they decide, I never signed up for this, I'm getting out before it gets worse. And that creates another layer of selling. So, for example, there was a lot of buying of stocks in the later part of December, and by all appearances, it seems to have carried into
they might be feeling good.
2019. I think the people that bought at the best levels of late December, I think that they will sell at a lower level than what they bought in at for that same type of a thing. They bought in, they thought it was a buy the dip, they felt emboldened by it, they've gotten an economic and psychic reward so far, but once that buy goes underwater, it will accelerate the selling because those people will turn into sellers, I think. And that'll happen in the corporate bond market too.
You think there's another leg down coming? Do you think this is a bear market that we're in?
Yeah. Oh, yeah, it's a bear market. I mean, this is, a bear market has nothing to do with this 20% arbitrary thing. It has to do with something crazy happening first, and then the crazy thing gives it up, and yet more traditional things continue to march on, but one by one, they give it up. So what was the crazy thing? Bitcoin. Bitcoin was the crazy thing. Bitcoin going from 0 to 20,000 in a straight line. It was crazy, and you knew it was crazy because other things started to happen that were truly insane. There was a thing called crypto kitties.
Yeah.
It wasn't a cryptocurrency. It was a collectible, but it had the word crypto in it, and they were each unique, but there were cartoon drawings of cats. And there was actually a moment where one sold for over $100,000. Of course, they're worth zero today. But that is a sign. That's like pets.com
Right.
back in the late 90s. That's like pick a pay, negative amortization, 120 LTV loans in 2006. Bitcoin was insane, and it crashed starting in December of 2018. Then the global stock market peaked a month later. Then the transports peaked, the utilities peaked. Then the Dow Jones Industrials peaked. Then the S&P peaked. Then finally the NASDAQ peaked. And then it was down to 5 stocks. And then it was down to 4 stocks. Then it was down to 2, Amazon and Apple. And then on October 3rd, it was over. And so that's how a bear market develops. And I think that it's been saved by the Fed's pivot. And it's been saved by the bond rally, taking some pressure off the stock market. But if the long end of rates starts to rise, as I expect, and if we break through 350 on the 30-year, I think it's over, because the competition from the bond market, particularly against a climate of limiting one of the engines of stock price appreciation, which is buybacks, is thought to be potentially in jeopardy. I mean, it is interesting that a Republican is proposing legislation to curb buybacks. That shows you that Marco Rubio wants to get in front of this issue before somebody on the other party claims it as their own. So the support for limiting buybacks seems pretty high.
So you mentioned Bitcoin, which was the mania. Do you think there's another mania? I'm thinking maybe in cannabis. That's kind of the one that people are talking about now. If you have an opinion.
Yeah, I've got young guys working for me that are big believers in the cannabis thing, and they claim that it's all about getting shelf space and branding and getting bought out by another big company. That's like the game. I mean, it sounds plausible to me, but I don't know. I'm pretty simplistic. I don't know why there isn't a corn mania, right? How come there isn't a corn mania? I mean,
Yeah, why not?
Grow corn too, right? I don't understand why just because it used to be illegal and, that somehow it's got this special magic to it. But, it's interesting. The cannabis thing does seem kind of like a mania. I mean, people probably make a lot of money in some parts of it, but that's just not for me. I have no interest in mania stuff. I just kind of watch bemusedly from the sidelines. What I do find that's a little bit scary is I saw a statistic this week that the increase in smoking among high school students year over year, 38%.
Because of the Juul? Vaping.
Because of vaping.
Wow.
That there is an explosion in smoking, which I suppose is probably like a gateway for the cannabis industry. So maybe there's something there. But I find that to be an incredibly horrifying statistic. Mm-hmm. In 1 year, 38% increase, and now over 50% of high school kids are either smoking, probably mostly vaping, I think, which is probably far worse than traditional cigarettes. I don't know, I've never been a cigarette smoker, but I wouldn't go anywhere near any of this chemical concentration stuff.
One thing that's always been interesting to me, Jeffrey, is you're out here on the West Coast, and people do look to you for your various calls and views, and I'm just wondering, how do you kind of sift through the noise? How do you get your information? What do you look at?
I look at news wires more than anything else, and I try very hard to pay no attention to what other people think. Sometimes people do things, they say like, name somebody that you admire or something, and I always think about it, and one person I really admire is someone that most people don't know the person's name. His name is Donald Judd. And Donald Judd was one of the great, you call him a sculptor if you want to, of the 20th century. He broke rules and made people angry because he actually didn't make the sculptures himself. He designed them and then sent them off to machine shops. And this was back in the 60s when he started. And that was considered to be, that can't be art because it doesn't have the artist's hand in it. But Donald Judd was an art critic in New York City, and then he tried his hand at painting. And he was, as an art critic, was very involved with the art scene, which was very vibrant in the late 50s and early 60s. New York was the artistic capital of the world, having moved it from Paris. And Donald Judd became very involved as a critic and then a painter. And then he decided that being in the New York art scene was detrimental to his own artistic vision because he was too influenced by Willem de Kooning and Andy Warhol and Eva Hesse and all these other luminaries of the time, and that it made him distracted, that other people's ideas were confusing him and taking his vision of his own art and making it more diluted. So he did something very radical. He got up, and thanks to the generosity of the Dia Foundation, who bought an old Korean army base that he had served at in Marfa, Texas, which is the definition of the middle of nowhere, he set up his art studio there in the old barracks and the old artillery sheds. And he wanted to get away from all of the noise. And by far his best work is in Marfa, Texas. It's the greatest art installation I've ever seen. It's hard to get to. It's like 300 miles away from any commercial airport, so you have to fly in either and drive, or you've got flying out to the jet strip there. And that really spoke a lot to me, because I realized that doing things like, there's some events that I get invited to all the time, like groupthink events. They call them like Titans dinners and stuff like this, and all these hot shots are there, all these names of people that we all know in this business. And they all, well, they'll all be there, and you can sit there and you will share ideas. And I did a couple of those years ago, and I would sit there, and here's Mr. Great, number one, and he's massively bullish on Apple. And then they turn to Mr. Great number two, and he's massively bearish on Apple. And both of their arguments sound really good to me.
Right.
So I'm sort of like, I don't know what I think now about Apple. I mean, I might have walked in the room thinking something positive or negative, but now I'm just confused. And so I think what's important is to look at the news flow and watch for those times when the news doesn't change, but the interpretation does. Or the news does change and the interpretation doesn't. Those are moments where there's this gap of opportunity. And I think my primary skill has always been living in that gap in a way that's quicker, maybe just because the way I operate, I don't know, than other people. And so that's the real key, is to look for harbingers and instances of the cusp of change. When you actually get a moment, you can act on it. I mean, strange things happen. I remember when Ben Bernanke, when things were looking pretty grim back there in 2011 or so, he said, we're going to keep short-term interest rates at zero for at least 3 years. He pre-announced 3 years of zero interest rates. And shockingly, many instruments in the bond market that were sure to profit tremendously from zero interest rates for 3 more years, they didn't go up in price for like half a day. And I bought them all. And I was like, why aren't people buying these? I don't know, but they should be like 20 points higher. And they were 20 points higher about 2 weeks later, but they were actually there to be had because people want to see the idea that they have get ratified or corroborated by a crawler on some financial program. And they, oh, I see, now it's safe to do this because everybody else saying that this is the conclusion you're supposed to draw. But by then it's priced in. So the opportunities, by the time it's safe and you have a confirmation that your idea might be broadly embraced, by then it's too late. So that's really the key. Also, just trying to find relationships. I have a whole team that what we do is we just look for correlations that might be common sense, but then you verify them. Some things that just correlate well. Like for example, things like the Fed's underlying inflation gauge, which doesn't get nearly enough attention. It correlates incredibly well to CPI, core CPI, on about an 18-month lead basis. It's got about an 80% correlation. Nobody knows about this. Well, we do. Unfortunately, I speak to people like you and I give my ideas away, but it's okay because relationships don't hold up forever. the world changes, the variables change, the coefficients change that drive things. And so it's really important that you sort of just stay on top of it. That's why I do what I do. I mean, I could have retired a long time ago. I find it very interesting as a way of processing human behavior, society, and just understanding what makes the world go around.
Well, I want to follow up on a couple things here. You mentioned that your team here, and I've met a few folks from DoubleLine in the past couple of years. How do you think about talent? What do you look for when you're hiring someone?
I generally like to hire people who either I know or who know nothing. I don't like bringing in people from other firms who have like 8 years experience because they've learned some other way. And it does not that the other way is wrong, but it's not the way we do things. And it's not that we do everything perfectly, there's only our way. But I like people who are right out of school because that way they don't have to be untrained from what they thought they learned somewhere else. And then I like people that I know the way they think. So we like people that are very analytic. We like people who are believe in shared success. I tell people when they start working here, at many firms, you succeed by killing the person next to you. If you even go in that direction, you're gone. I want people to want the person next to them to do well, because the person next to you doing well means the firm does well. And so we have a shared success philosophy, and it kind of comes from the top because I never yell at anybody. My philosophy is everything that goes right, the team did it, and everything goes wrong, it's my fault. And I think that people appreciate that.
You mentioned that you could have retired. I'm sure people ask you, oh, you know, you're successful, you can retire anytime. What is it that keeps you going? What is it that drives you?
It's not really working, is the thing. I just process the world through human interaction, which in this particular instance reveals itself through financial markets movements. And so I just sort of like it. Also, I'm committed to a couple of charitable enterprises that basically need a lot of money.
Right.
So it's a good reason to work so that it can be funneled not just to the Internal Revenue Service and the United States Treasury, which I am a very significant contributor to, but also to something that I think matters rather than just some rat hole of administrative waste. And so I don't really resent the fact I pay so many taxes. It's sort of a privilege in a certain sense, but I also want to be able to see results for the money that I'm giving away.
You can have impact.
And it's a very big impact when it doesn't go through a bureaucratic machine.
How about when folks are saying, they should have a 70% marginal tax rate on the wealthiest?
Well, my marginal tax rate is presently combined California and U.S. 52.6%. I'm deeply offended when people tell me, no, it's not. I actually have had people say that to me. No, it's not. Rich people like you only pay 15%. I'm telling you, it's 52.6, all right? So that's because California's 13.3, and then there's the federal, and there's other things. So if they raise it to 70%, that'd be a 33% increase. I would go to 85.6%. I really think I would stop working.
Yeah, who would even work at that point?
I really think I would stop working at 85.6. So the tax policy is pretty strange because a lot of people that are in my financial position really do pay low taxes. I remember Mitt Romney, I think, he had a 14% tax rate on some tax return that he revealed as part of his run for president. I mean, 14, it's just amazingly low. I agree that's ridiculous. But instead of raising me from 52.6 to 85.6, I think the 14ers should come up to 52.6. That's what should be happening. But I guess I'm just kind of in a very, very small minority. And so the others protect the 14 potential. So tax policy is really weird. It's really weird to me that people making exactly the same amount of money pay very, very different tax rates.
Well, I know one of the areas that you're really focused on when it comes to philanthropy is art, and that you are a passionate art collector. How do you think art influences your career, your investment career?
I don't really think it does. I think it's just very different. I mean, art is, it's very subjective. So I think it's a balance more than a tie-in to what I do. What I do, running money, other people's money, is amazingly, at the end of the day, non-objective as to whether you've done a good job or not. It's actually painfully objective because it's a number to 2 decimal points or more. And it's your number versus that market number versus some other investor's number. And there's kind of no getting away from that. It's incredibly easy to judge. Whereas art is incredibly subjective and you can't put any kind of definitive number on it. And so I kind of think it's a yin and yang thing.
One thing I do like is when you get off the elevator, you see DoubleLine. You see the painting that you actually did. Tell us the story. What does the name DoubleLine mean?
Well, it's interesting. I, for some unknown reason, in about 2005, woke up in the middle of the night, which I almost never do. I'm not one of these can't sleep at night people. I often get asked what keeps you up at night, and I say nothing. I mean, nothing. Nothing keeps you up at night. Well. Yeah. So I woke up in the middle of the night. For some unknown reason, I was obsessed with this idea, which I never even thought about before. If I start a money management firm, what would I call it? And I was like, it was just kind of a fun thought experiment. And so many names are meaningless. They're named after an intersection in a city, or a Greek god, or some sort of gibberish, like First Financial, or if there is one, I'm not trying to insult them, but names that don't really mean anything, or rivers, or something like this, lakes, geographic places. I was like, I'd want a name that kind of meant something. And so what would be a good name? And I had just bought my first Mondrian. And it's his last great classical painting where 2 devices are used. One was an early device called a progression, which is basically rectangles that progress. And the other was a device he came up with in 1931, which is called the DoubleLine. And the DoubleLine is a further ambiguity between line and plane, because there are 2 lines that are close enough together that they look like 2 lines, but they could also be interpreted as kind of defining the negative space of a rectangle by bordering them. So I had this picture, and it's got this, the DoubleLine, and I was thinking, this DoubleLine, that'd be a really good logo. And then I realized that it had a meaning, that the meaning was in everyone's life that they experience more frequently than like people go, DoubleLine, there's a DoubleLine in the middle of a highway. Right. And it's by law, you're not supposed to cross it, but it's really there for your protection. At least you like to think it's there for a reason. And the reason, of course, is it's not safe. And so I realized, hey, that's pretty neat because I'm really risk averse. I think more about what you shouldn't do than what you should do. And what you shouldn't do is take fatal risks. That's what kills particularly fixed income investors. If you buy a lot of junky bonds and they default, your money's gone forever. If you buy a bunch of mortgages and they refinance at the wrong time, you've kind of lost money forever. But so it's what you don't do. And I thought that's perfect because it defines things that we won't take certain fatal risks. I was giving a speech years ago now. It was way back in our second year of business or something. I was giving a speech, 2 speeches in one day. One was in Bakersfield and one was in San Luis Obispo. And in Bakersfield, it's really interesting. It's a very wealthy community. You wouldn't think so, but it is. A lot of farmers and there's a lot of oil there. And I went to gave this speech, and a lot of guys showed up in overalls. They were farmers. There was a guy that was like the #2 potash guy in the world or something. These billionaires, and they show up in overalls. And I said, hey, I'm looking at my map. I've got to go to San Luis Obispo. There's 2 roads, and I can't really tell which is the more efficient route. And the guy says, whatever you do, don't take this one. I go, why not? He said, it's called Blood Alley. I said, really? He goes, yep, there's more fatal head-ons on that road than any other one in the state. And the reason is that it's tractor country, and it's very windy, and it's 1 lane each way, and tractors go slow, and people are impatient. And they just decide they're going to go for it, and their trucks come the other way, and they get wiped out. And that's why it's called Blood Alley. And I said, that's fantastic. That's exactly, and I started talking about the name of the firm and everything. And it was pretty interesting. And so we took the other road, obviously. It was pretty cool. We went over the San Andreas Fault, where the road has a massive sort of whoop-de-doo in it. It's really surprising. And I was like, what was, because I was like, what was that? And so someone said, that was the San Andreas Fault. That's right halfway between those 2. So anyway, that's kind of, the DoubleLine had, it really came to life with that guy in the overalls.
Well, before I let you go, seen you on Twitter in the last, I don't know, when did you join?
It was at Iris Sohn in
Iris Sohn,
2017.
That's right. So what's your take on social media now that you have somewhat of a presence?
I have no presence. I follow nobody.
But you tweet a lot and you get a lot of retweets.
Well, I don't tweet that much, but I do sometimes. I'm just trying to give people an insight into what I'm really thinking. I get a lot of, there's a lot of misreporting that goes on in financial media. There's a lot of people that report on what somebody reported on, and like that old telephone game that you do in first grade where you go through the class and it ends up starting to be, you know, the sun is shining and the last person says the cow is in the hotel and you can't figure out how the message got so altered. But that happens with re-reporting. And I like to tell people what I really think. So I like interviews that are live or ones that I do a written statement, because I find when I do webcasts, for example, the stuff that gets reported, more than half of it's wrong. I mean, no, I didn't say that. They'll leave out the word not and invert the meaning. So I like to have the Twitter account where if something like that goes off, I can say, you know, this is actually this is truly where I'm coming from.
But we'll never see Jeffrey Gundlach on Facebook?
Never on Facebook. I don't know what Instagram is. I've never downloaded an app in my life.
Do you still have an opinion on Facebook? I do remember you spoke about it. It was a pair trade at Sohn maybe last year.
Yeah, and you know, it fell a lot. It's rebounded back up. I just think that Facebook, their big problem is obviously their business model. And I talked about things that are safe that end up being unsafe. I think that's Facebook. I mean, they sell themselves as comfortable and safe, but they're really just a diabolical data collection monster. And they're unrepentant. And I just saw yesterday they're talking about more regulation in Europe, in the UK. And when the regulators show up, usually the stock prices go down. Like healthcare had a meteoric rise until the regulators showed up a few years ago, and then a big decline. So I don't really trust Facebook. So the fact that I don't trust them makes me not like them, and the fact that I don't like them makes me want their stock to go down.
There you go. Well, Jeffrey Gundlach, CEO of DoubleLine Capital, it's been a pleasure. Thank you so much for your time.
Thanks again for coming.
Of course.
Ray Dalio, the founder, co-CIO, and co-chairman of Bridgewater Associates. Thanks so much for joining us today.
It's a kick to be with you.
Yeah, so we're here at TechCrunch Disrupt, and you are now the face of an app, right? Principles, and it's been getting a lot of heat and traction over the last couple of months. What is the success story behind Principles, and why do you feel like it's been performing well?
To know how to fail well, you know, and to realize it's the path to success, to know that knowing how to deal with one's not knowing is more important than anything one knows. To know how to have an idea meritocracy, and to know how to have fun and go after your dreams and make that happen. And so it's a kick to pass that along.
So it's really interesting. The app itself, you're giving people the opportunity to craft their own principles, right? In addition to following yours, it's almost like, okay, this can be your vision board as well. What would you say is the most creative sorts of principles that you've seen others contribute to the platform?
Well, we're just starting to collect the principles. So but you know, there's the themes that you see over and over again, and they're true.
Yep.
So I wouldn't make the generalization. I can't imagine the ones that I would say are the most creative, but they're mostly how to get past the challenges, the pains, and all of that. So I would say that maybe those.
As you look at your principles personally, what is the most challenging one for you to really hold true to, or you feel as though you face the most obstacles in trying to make sure you're consistently meeting that principle?
Well, I don't know if it's the most valuable one is to meditate. I would say it's not the most challenging, but I want to do it the most because that gives me the equanimity, the creativity that really helps so much. So I would say that would be one of the most important, certainly.
You've rolled out some new tools as well to really help entrepreneurs and leaders. Can you explain the new push here?
Well, I want to pass along all the tools that have been helpful because tools create habit, they create a framework that allows all these principles to be carried through. I want really an idea meritocracy. That's the most important thing. And so the tools allow that. So I'm passing along first the dot collector. So everybody's going to be available for you able to use the dot collector. And I think that'll be terrific. It's our most loved and most impactful tool.
And what would you say is the success story? What is your vision for Principles as you look ahead to a year or two from now? How would you define success?
Well, at every phase in anyone's life, there's a difference in what one defines success. For me, at this stage, my definition for success is to help people be successful without me. In other words, to pass along and to watch.
Institutional memory, yeah.
Well, to watch beauty happen. I feel I'm 70 years old. I don't want any more success myself. I just want to help pass that along, and if I can do that, that'll be success for me, and then I'll go quiet. I'm going to go quiet in about a year and a half, I think.
You know, some core tenets of the concept of Principles and of Bridgewater are really radical transparency, radical open-mindedness. When you look at Silicon Valley, where we are right now, what would you say are the pros or some of the startups and companies out here that are doing that well? Can you name a few leaders that come to mind?
I'm not going to, it's all personal and I keep it private, so I'm not going to name leaders, but I will say that some of the most successful, innovative companies, and then some of the startups that are just getting going are open-minded and thinking about new and better ways of doing things. So Silicon Valley, I love it because they really resonate the idea of meritocracy, to know one's strengths and one's weaknesses, to work in a community where there's meaningful work and meaningful relationships. It resonates here. So that receptivity is really big here.
And you know, you personally have really taken to social media platforms like Twitter, like LinkedIn, to really be an author, right? In addition to your book, and you're finding avenues to express yourself and engage with customers and people who are interested in your words. Would you say LinkedIn is the best portal?
I want to clarify what I'm doing. Like I was sort of like hesitant. I'm going to go on social media, and I don't know, and I'm not doing it for most of those reasons. I'm doing it because I'm having quality exchanges with people. You know, every day we're exchanging thoughts on Principles and we're having the back and forth, and the people are really nice and they're very appreciative, and I love communicating with them. So, you know, I like that. We're communicating in very honest ways. But most importantly, it's quality. Like, what are you facing? And to realize that whatever you're facing, there's a principle for it, right? To not view each of these individual things as individual things, but part of that principle. That back and forth exchange has been really well. I'm loving the communication.
I want to briefly touch upon your latest LinkedIn post where you specifically are addressing the administration potentially curbing some of the investments into China and the capital flows there. Would you say that is the optimal scenario? Is that the way that the U.S. government should be going about relations with China?
No, I wouldn't say that. There are four types of wars, right? There's a trade war, there's a capital and currency war, there's a technology war, and then there's a geopolitical war. And I'm seriously concerned about the nature of those wars. So, it has to be done. This exchange of how you accomplish things we shouldn't even be using the term war. We're using it too easily. We should be using the term negotiation, I think. So, the question is, how much will this be a fight in which there's mutually hurting each other? Is this a win-win or a lose-lose? However we can get to a win-win, that's what I would like to see the most of. It's the art of thoughtful disagreement. And how do you create win-wins that I would like to see the most of? So I would say more concerned about conflict than the way that we're having it.
And when you think about that win-win scenario, what does that look like, for the U.S. and China?
Well,
do you see that sort of compromise happening?
I don't think it's just a U.S.-China. I think it's an American thing. In other words, I think when we're dealing with conflict, we're now saying, can we go above it so that we don't make it a lose-lose, so that we know how to get what we each want through exchanges. Like, you tell me what you want and let me see if I can help you get it, and let's do the same so that we build on win-wins. I think we're having the same challenges domestically. There's a wealth gap, and there's an opportunity gap, and then there's a conflict between increasingly extremes and a fight that can become a really dangerous fight and produce a lose-lose. So I think the issue is to go above, if we can go above it, and we say, how do we get the best collective benefit, and work on that. That's now lots of ways we can do that, but that is, I think, the most important thing. Because if you look about what we can have, there is enough. Okay, there is enough of everything, and there's an innovativeness, and there's a capability. But so often, there's been these lose-loses that can then be very damaging. And so I'm concerned about that. So like the wealth gap, like the opportunity gap, the idea of coming together and working it together and understanding the art of thoughtful disagreement. Principles, go back to principles. What are the principles that bind us together? Are we clear on those? What are the principles that separate us? So I think we have to think about how we do this in a together way before we really damage ourselves, because it can get so extreme that it can be damaging.
And on that point, when you think about unity within America, of course, there seems to be a lot of divide within the U.S. political system. When you think about the impeachment inquiry that Nancy Pelosi did start on President Trump, do you feel like that will be a headwind for the markets as you think about the next couple of months?
I read history, and I find the same things happen over and over again. And what I see is that there is a political system that normally has an ability to debate things and get past that. And I'm worrying that this is a war in which the damaging and the hurt of that war can be so great that it undermines the effectiveness of the system. History has shown that. If you look at the late 30s, for example, the polarity between the haves and the have-nots, the wealth gap was analogous, the opportunity gap was analogous, and the ability to get past that. So I'm more concerned about that. I think there are three big forces that are at work. That's the domestic economic gap and political gap, which is becoming extreme, and I worry about a downturn in which, number two, monetary policy won't be as effective in the next downturn. If we're at each other's throats now, and then you have a downturn, and it's going to be worse.
Yep.
And then we have the conflict in terms of the rising, China as a rising country with the United States as an established country. And so to work oneself through that in the right ways with wisdom, to understand the art of thoughtful disagreement and get at the right aggregate rather than an everyone lose situation. That's what, so that's what worries me.
Hopefully we can achieve that soon. Thank you so much, Ray,
Hopefully we can
for
achieve
joining
it soon.
us. Appreciate it.
Blackstone founder, chairman, and CEO Steve Schwarzman sat down with Yahoo Finance's Julia LaRoche for our series Yahoo Finance Presents. And Julia joins us now to discuss. Julia, how'd it go? What did he say that stood out to you?
We talked about so many different things, Dan, and one of them was whether or not Steve Schwarzman would get a job at Blackstone if he were to apply today. And guys, the answer is no, so take a listen to why.
I'm trying to feel how smart they are, how stable they are, how curious they are. And usually you can do that by just looking into their eyes. And sometimes I'll walk in a room and talk about what I was just doing if it's exciting, and if they recoil with fear because it's a different situation, they probably won't be able to handle things that come at them in an unpredictable way. What you want them to do is hold the table, to be pretty much of an equal, because they are. Mm-hmm. Just because you're senior, all that means is that you've had more experience. Doesn't mean that you're better than anybody that you meet.
Well, I know it's really difficult to get a job at Blackstone. I was reading some of the stats in the book. So I have to ask you this. Do you think if you're applying to a job at Blackstone that they would hire you?
Well, this is what I worry about, because I don't think they would.
Why not? Because
my grades, I wasn't a summa cum laude or magna. I wasn't even a cum laude. So there are different modes of learning. I'm not so bad at some of this stuff, but it's not because I test to a degree that a lot of the people we hire. So I think it's important that we look at different factors here at the firm. The conservative way is always hire the brightest person. I think it's important to be involved in student government of some type, or a club, or something where you demonstrate leadership. I tend to like people who are athletes only because you can take pain. You know, if you're a good athlete, you push yourself to a point where it's not pleasant.
Please welcome Julia LaRoche and Stephen Schwarzman.
Steve Schwarzman, CEO of the Blackstone Group and the best-selling author of What It Takes. It's so great to be back with you again.
Good to see you again.
All right, well, Steve, the last time we talked, you gave me an answer to a question that I asked you about, that you didn't think that you would be hired at Blackstone if you were to apply today. So my follow-up to that is, do you worry that Blackstone and maybe other firms might be missing out on the next Steve Schwarzman?
Well, I think it's always hard to know exactly who to pick when you have a qualified pool. I'm quite sure, unfortunately, I wouldn't be picked because I wasn't magna or summa. We talked at our management committee about this issue, and I asked how many of you were, only like 8 people, 9 people, how many of you were magna or summa? One hand went up. How many of you were cum laude? No other hands went up. So the rest of us were like generic people, and we're pretty flexible. And you know, as organizations grow, you end up, you know, sometimes hiring really very bright people. But I think that people who have a balance, you know, it's good to be smart, obviously, but having leadership skills is really important, and playing sports is good too. And the reason for that is you learn to take pain, and it's not easy to be successful. You know, it requires a lot of effort, there's a lot of setbacks. It's a little bit like sports. You get thrown on the ground, you got to get up. So we hire less than 1% of the people who apply. It's surreal, and we have amazing people, but we always make sure that we have a few of them like myself with more generalized skills, and it's something we're always refining.
Mm-hmm. Well, you've been in this business for decades. I do want to go back and revisit some of your early years. In your book, you wrote that at DLJ, I was never trained properly. I would cower in my office hoping no one noticed me, scared that I would be found out as ignorant or incompetent. I must have been the biggest buyer of antiperspirant on the east side of Manhattan. And then when you were at Lehman Brothers, you told this story about working months on this fairness opinion. You submit it, you're so proud of it, and then you get this phone call from your boss that there's a typo on page 56. So I have to ask you, how formative were those experiences, and how did it shape the way you built the culture at Blackstone?
Yeah, well, everybody knows that sometimes when you start out, it's a rough ride, and it was definitely rough for me. I had no training, and I was like the person in a class at school who, whenever they asked somebody to open the class, you try and position yourself behind somebody else's head, so you wouldn't get called on. And that was because I wasn't trained. And so what happens is when you have these bad experiences, you don't forget. And when you sort of make sort of a vow to yourself that if you ever got into a position of authority, you wouldn't do that to anybody else. Mm-hmm. You want people to be as prepared as they can be. You want as low a stress environment for them. You want them to understand that they can ask questions. I'm in the financial business, and almost everything's been invented before you did it. You know, certainly for your first few years. So let's not have you struggle. It's absolutely okay to ask questions. As a shortcut, you're not allowed to ask the same question over and over again, which means you've learned nothing. But the idea that you have to struggle, let's eliminate that. And so each of these unhappy experiences, we have a great training program now because I want everybody to be trained. I want everybody to be comfortable.
Well, I do want to also talk about the fact that you excelled from an early age on Wall Street. I think you were one of the youngest managing directors at Lehman Brothers by age 31. But fast forward to today, and then even looking out in the future, how do you think the financial services industry has changed, and is it still a viable place for young people to go?
Yeah, it's a financial business is still really good. It's just changed. And as long as you're printing in the United States an extra $1 trillion a year of money over and above what you would normally do with these deficits, there's always plenty of money and plenty of new things that you can do. At places that are larger, our place has 2,500 people, so it's not that big. You design people's careers so if you're really terrific, you move faster. The idea that the world has to be rigid to make life easy discourages having, people of great talent. And I love people who have talent. I was always sort of a bit frustrated by being held back, and why should we do that? So you don't have to be a big thinker. You just look at things that don't make sense and say, I'm not going to do that.
I also think it's also interesting, you have these rules for life, you talk about finding problems and solving them, you say that there's nothing more interesting to people than their own problems. Think about what others are dealing with and try to come up with ideas to help them. I mean, it makes me think of when you were in high school, you brought on a cool rock band, you changed the rules at Yale so women could spend the night on dorms, you also made sure that the folks you were in the Army with got fed, they weren't feeding them breakfast when they were doing their morning tours, and you also solved problems whether it was business school, Wall Street. So what was the inflection point for you that you were looking to solve problems in your life and realized, hey, this is actually good for being successful?
Well, whenever you're in any kind of situation, the reason you're there is something's going on. And what you really want to know is what is the problem that you're solving? And the only way you learn that is you think you have an idea, but it's really the other person you have to understand. And what's on their mind, and how do you address their issues? If you're like a young person, pretend you're in an advisory capacity. All you want to know from your client is, what are you worried about? What are you thinking about? And once you understand that, it's pretty easy to create solutions. If you're just guessing about what's on their mind, you'll waste a lot of time and maybe not get the right thing.
Well, I do want to talk about the problems that this generation will be facing. Right now, we're in the middle of trade negotiations, and I know you wrote about this. You are involved in that process. It's been ongoing. You write that it's some of the most difficult negotiations you've ever experienced. So, Steve, are we going to see a deal anytime soon? And what has to happen for us to see a deal?
Well, that's almost an unfair question, because the Chinese are sitting in a room either right now or they just broke with the Americans. So it'll be announced. And what I think might happen today doesn't really matter, because today's almost over. And we'll all know where things are. But fundamentally, we're asking the Chinese to change their system. Their system was brilliantly designed as an emerging market, developing market economy, so that much like the Americans in the 19th century, people forget we had very high tariffs. We were a small country. We had, the ability to protect, our nascent industries. And China just started doing this 40 years ago, and they've had an astonishing result. 40 years ago, they had GDP per capita of a few $100s, and now it's $10,000, and it's going up at $1,000 a year. So China has done some remarkable things, but they've done it in ways that are inconsistent with the developed world. They have very high tariffs and taxes, 3 times as high to bring a product into China as it is for China to sell one in the United States. You would assume, if that were the case, the person who gets in at a very cheap price would do better, and they do. It's the same way with markets opening. It's selectively open, but not like the U.S. has been. And so I think it's a time for adjustment. The question is, how fast will an adjustment come, over what time frame, and how dramatically at each point? Because no one would give up their entire system because someone else asked them to do it. So we're doing the asking, and they have their own internal politics. They've got their hardliners, which is basically, things have been really good for us, plus we don't like being pushed around, which they were, by the developed world for the last 100 to 200 years. And they don't like it. On the other hand, you have the reformers who say, look, we realize that we should be more open. We'll learn best practices from the West. It'll be good for us. So in a way, these negotiations are somewhat hostage to what China wants to do. And there are two elements in China. Just like we have internal politics in the United States, our view that they're a monolith and they don't have internal points of view is wrong. So we'll see what's happening. It's an exciting time now.
Are you optimistic?
It depends on what criteria. If you're looking for a full solution to the differences between the US and China, that's not going to happen. If you're looking for something less than that, we'll have to see what China is prepared to put on the table.
Well, Steve, you're no stranger to the White House. I know you've engaged with several administrations, and you wrote about this in the book that, quote, from the moment Donald Trump was elected president, I had been getting calls from people who did not know what to make of him. They had listened to him during the campaign and were nervous about what he might do. So what do you tell folks? What do people get wrong about President Trump?
Well, that would take a long time to answer that question.
But if you could, narrow it down to one thing that people get wrong.
Well, I had a lot of people from foreign countries, as well as domestic people, sort of approach me. Donald Trump lived in New York, for his whole life, and we're in New York now, and New York isn't as big a town as it seems on the outside, and so a lot of people knew Donald Trump, and nobody knew what he would be like in a presidential position. And so they were basically without any knowledge and had a lot of concerns about it. And so, I would meet with them and see what was on their mind and see if I could solve some of the issues. But, one of the things is that all of these tweets are not worth listening to. And for some reason, everybody is focused on them all. And I never have been. Some of them are just indicative of sort of a general area of concern and aren't meant to be taken literally. And, with today's news media, it doesn't matter whether it's left or right, people just hang on every word. I've always thought that would drive them sort of nuts, and that's where they've ended up as a society. And I think you have to wait to see something of real importance that's more considered, but that's not what the media is doing, and so you get all this confusion and focus where there probably shouldn't be focus, but it's just my point of view.
All right, well, we are coming up on the 2020 election, and you are the son of a dry goods seller. You are the American dream. You are now the 100th richest person in the world, according to the Forbes list. But as we approach the election, you're seeing more and more candidates come out proposing a wealth tax. You have one who says billionaires shouldn't exist. You're also seeing polls that are more favorable towards socialism. So what is your response to that?
Well, there are a bunch of different responses as to this thing about billionaires it shouldn't exist, that if you look at who these people are, they didn't become prosperous sitting and just watching television. These are people who started businesses. And every place where everybody works was started by somebody. And that's the way the world works. And the people who take that risk and start those businesses and end up, you know, either you're hiring 10 people, 100 people, 1,000 people, 10,000 people, 100,000 people. That's where people work. And those people make more money. And what happens is they become affluent. Most of them fail, by the way. 9 out of 10 businesses that are started result in failure. So if you're one of the people who make it through that, you're providing employment and prosperity and, in effect, tax revenue. And you have a bunch compared to other people. And then you get older and you pass away, and the laws, you know, sort of tax away most of what you have owned. It's already been taxed once already, typically, and then that's dispersed, and then that wealth disappears.
You know,
and so that's how these people get created, you know, in terms of a wealth tax. I don't remember whether there are 210 or 220 countries in the world, and only 4 of them have a wealth tax. If it was such a good idea, and it was so easy to raise money, you'd have loads of them. You've had more than 4, and they give it up. So why did they give it up? So Yahoo addresses a lot of younger people who want to start businesses. And here's how this would work if you were trying to start a business and you got venture capital money. Make pretend that you were successful and your company, make it really a good success, was worth $1 billion on a valuation basis. And you started it, so you had $300 million of the billion. But you probably had a salary of somewhere around $300,000. So what would happen is you'd end up with $150,000 after tax. And if you had a 1% tax, you'd owe another $3 million. So how are you going to pay $3 million of taxes when you only have $150,000? So this would be a terrible situation to have created something, be successful, and be hemorrhaging financially. So that's how a wealth tax works. And what would happen with that person is they would not want to stay in the United States.
And leave.
They would leave, but what's more important is people who would come here to start businesses wouldn't come, because the success would be taxed away in a wealth tax. And so what is logical is those people would find another place to go, and there would be another ecosystem developed. You would have, I think, countries offering them tax-free zones to do their business. And you would basically create a huge dislocation for the United States. So I think there are reasons why wealth taxes don't exist. And I just gave you one of several.
Well, before we let you go, you're a problem solver. You look for big problems and you want to find solutions. We're starting to see some of your peers, I'm thinking Ray Dalio of Bridgewater Associates, Salesforce's Mark Benioff, come out and say the current capital system is broken. So using that problem solver mentality, Steve, how would you advise that we fix it?
Well, I think it's pretty clear that as a result of a Fed study done 2 years ago, that 40% of Americans, the Fed said, couldn't write a $400 check in an emergency. So what that means is this 40% of the population basically doesn't have savings. And they are having a really, really tough time, which is why our politics has become poisonous, because we've got a large percentage of our population that's not doing well. And I think you have to address that. First, you have to provide more money for these people. And I think there are a lot of different policy approaches. I think a good place to start is to increase the minimum wage up to $15. This is actually a tax on the business community, right? Because you're taking profits away from them to give them to workers. That takes care of significantly increasing money for 15% of the population. But what happens is the people who used to be getting more than the minimum wage, they have to be boosted up when you're close to doubling. So this ends up affecting somewhere around 35% of the population. And it's got lots of knock-on effects. That's the first thing. But capitalism isn't broken per se. What's been broken is our educational system. So when I was younger, which apparently was a long time ago, but I didn't get the word on it, that the US was one of the top 2 or 3 education systems in the world. We've now fallen somewhere between number 25 and 30, and in math, we're solidly in the 30s. If you're producing a workforce that is dramatically inferior to competitors on the global scale, we're going to have a lot of trouble. I was just in China a few weeks ago, and I was meeting with one of the top few people in their government, and he was telling me, he said, you know what we're going to do in education? We spent an hour on education. And he said, we're going to require that every student in China take computer science. And I'm sitting there going, OMG. In the United States, we probably have 5% of our primary and secondary students taking computer science. It is not capitalism that's broke. Imagine we're competing with a country where everybody is computer literate and we've got hardly anybody. This is not a recipe for long-term success. And it's not about capitalism. We have to put the best possible individuals and training on the playing field. That's how you win the game. And we're just not doing what we need to do in that area. And if you deliver those people to a workforce, you're really disadvantaged. So I have a slightly different take. These are government issues, by the way. They're not business issues. But there are a lot of things that business can do to help train people. We have to do that. We have to make sure that students who aren't necessarily on a college track do stuff like they do in Germany, where the business community, trains those people for real jobs, takes them on board, and gives them good careers. So we have a lot of levers that we can play with to have better outcomes for the people in the country, and we have to do that. This is not optional.
Well, you know what I think? These sound like generational opportunities. Stephen Schwarzman, CEO of the Blackstone Group, thank you so much for joining us at the Yahoo Finance All Market Summit.
Hey investors, Zach Guzman here. Are you interested in learning more about the markets and getting the latest financial news? Well, then click right here to subscribe to our Yahoo Finance YouTube channel. Get the latest up-to-the-minute market analysis, big interviews in the world of finance, and information on how to manage your money every day wherever you are.